If you've ever stared at a massive spreadsheet of raw real estate metrics and wondered, how on earth do I sequence this into a working analysis? Well, you're in exactly the right place. In this explainer, we're taking the raw data from the BLF Jaipur Development case study and translating it into a clear, logical blueprint for a financial viability model.
We're going to structure our approach exactly like the tabs in a professional financial analyst's model. So we'll start with the project overview and land, move into financing the development, build out our residential and commercial blueprints, map our sales strategy, and finish up with buyer financing and revenue.
Okay, let's jump right into Section 1, Project Overview and Land. Because to build a real estate model, you've got to buy the dirt first, right?
The anchor puzzle piece of this entire viability analysis is the land cost. We're looking at a 900 million INR price tag for a 30-acre plot. If you run the math, that is exactly 30 million INR per acre. This right here is day zero of your cash outflow. It's the absolute baseline metric that dictates exactly how dense we need to build and how high we need to price to actually turn a profit.
Now, on those 30 acres, we're applying a built-up factor, essentially our density multiplier of 2.47, which projects out to a massive 3.2 million square feet of built-up area. The strategy for this footprint is overwhelmingly focused on housing. We've got 92% of the project dedicated strictly to residential use, leaving a highly strategic 8% carved out for commercial space.
Moving right along to Section 2, Financing the Development. Now that we know the scale of the build, we have to map out the capital stack. So how does the money actually move? BLF developers are covering the entire land cost with 100% of their own equity, and they're targeting a 24% equity hurdle rate for their investors. But when it comes to putting actual bricks on the ground, they're relying entirely on a construction loan at a pretty steep 14% interest rate. Make no mistake, that 14% ticking clock is the debt dynamic that will truly define whether our model succeeds or fails.
All right, Section 3, the residential blueprint. Let's unpack the biggest bucket of our revenue.
Here is something developers literally dream about. Every single square foot of our nearly 3 million square foot residential area is 100% saleable. Zero wasted space on unsellable common areas. And to maximize those returns, the space is split into a very calculated mix. We're putting 67% of the square footage into high-density apartments and reserving 33% for premium single-family homes.
This right here is the beating heart of your residential model assumptions. Look at the stark contrast between our volume play and our margin play. We've got 1,658 high-volume apartments costing 1,000 INR per square foot to build, launching at 1,600 INR. Compare that to the 653 single-family houses. Sure, they're pricier to construct at 1,400 INR per square foot, but they command a huge premium launch price of 2,400 INR. Balancing this unit volume against premium pricing is exactly what drives the top line of our analysis.
But remember, a financial model is never totally static. Our construction costs are going to inflate by 0.5% every single month. Luckily, our sales prices are projected to outpace that, appreciating at a full 1% monthly. Over a multi-year project, that compounding spread is huge, meaning timing our sales correctly is absolutely crucial for maximizing those profit margins.
Let's pivot to Section 4, the commercial blueprint. Time to look at our 8% commercial slice.
Now here is the crucial assumption that will literally break your model if you miss it: the efficiency factor. Unlike the residential side, only 80% of our commercial space is actually saleable. The other 20% lost to lobbies, hallways, and elevators. So that leaves us with roughly 206,000 saleable square feet. We're breaking these into 2,000 square foot units costing 1,500 INR to build, but they're going to command our highest launch price yet, at a whopping 2,500 INR per square foot.
Okay, Section 5, Sales Strategy and Timelines. We've got our costs and prices. Now we have to plot out exactly when the work happens and when the cash actually moves.
Looking at our 36-month project lifecycle, residential sales kick off concurrently with construction, right at month 6. But take a look at this massive strategic delay. Commercial sales are held back completely until month 24. Residential sales wrap up at month 30, all construction ends at month 35, and commercial sales close out the whole shebang at month 36. Delaying that commercial real estate for 2 full years dramatically shifts exactly when we get to recognize our most lucrative revenue stream.
Finally, Section 6, Buyer Financing and Revenue. Because as we all know, a sale on paper isn't cash in the bank until the buyer actually pays.
We are balancing two drastically different cash flow mechanics here. Residential buyers are on a really slow 18-month drip. They put 15% down, followed by small increments stretching out for a year and a half before paying the final 55% at possession. Commercial buyers, on the other hand, are a massive sprint. They drop 25% upfront and clear their entire remaining balance just 3 months later.
So as you plug these final assumptions into your spreadsheet, I want to leave you with the ultimate puzzle you have to solve. Will the delayed but rapid cash injection from those commercial units starting in month 24 be enough to sustain the project's massive debt load? Balancing that ticking 14% construction loan against a slow 18-month residential drip is the true test of this project's viability. Run the numbers and let's see if the math holds up.